give us your take on what we saw this week. I guess maybe we start with the bond market because that was really pretty dramatic, wasn't it?
Oh, it really was. The curve flattened, the 2-year at 5, and now the long bond at 5. It's as if the curve has a six-pack because it goes in. Unlike me, where I go out, it's in good shape. But that's a big move. 30 basis points on the 10-year and the 30-year. That's huge, David. And the bond market is doing the Fed's work for them. So I think they're happy.
Well, so what do you do about that information? What do you do with that? I mean, you've really pointed something out I couldn't quite figure out. Why the 30-year really went up so much and then the 2-year didn't move at all, essentially?
No, it's true. Normally you worry about geopolitical risk, but you had a lot of Fed commentary this week. Number one, that they're probably not going to do anything in November, but they didn't take anything off the table for December. And enough statistics that make you worried that inflation is running high. Yet the economy is running strong. You had a great interview with Jay Powell, and he hit it on the head. The economy hasn't really reacted to these higher rates, and I think the amount of U.S. Treasury issuance is causing people to really step back, and that's causing these rates to drift higher.
So the value of bonds has gone down. It's been going down for a while now. The yields go up. I think we saw a fair amount of reaction in stocks, which in some weeks we haven't seen so much. We've seen some yields go up and the stock market do pretty well. This week, not so much.
No, that's true. But, David, I would get the charts out. Let's get a little technical. If you look at the market, had a high on September 1, then October, or back to even August 31st, then in October, and now here in the middle of October, you're having lower and lower highs, and that's a downtrend that I think is really making the market worried. You closed below the 200-day moving average today, which is a really important support level. The next stop is the 100-day weekly moving average, and then below that, you could be at the bottom of that ELF range where you had that low forecast.
So, Chris, you're responsible for a lot of money and a lot of pensions out there. Give us a sense about that balance between stocks and bonds. We actually had Jay Powell address that in part this week. This is part of what he had to say about that balance.
Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up.
So, Chris, what about that? Whether they're a more less attractive hedge or not, bonds must be more attractive right now when you go in and buy them because you're going to get higher yields.
Well, you hit it on the head. The bonds are lower in price, but they are more attractive to investors in terms of yield. We have seen bond correlations go up. Remember in 2022, we had stocks and bonds both drop over 8%. So investors really need to find ways to diversify. And in a 401k or an IRA, that's hard to do. But in our case, we can diversify into private credit. We can diversify into physical assets like infrastructure, real estate. The whole key is you got to put your eggs in more than one basket. And as Jay Powell's pointing out, the main two, stocks and bonds, aren't going to exactly be the best mix for you. And he's implying that he wants rates to even be higher. So I'm not saying higher for longer. I'm saying just plain higher. Rates are going to be at 5% around this range, probably for a considerable period of time.
What about within the credit and the bond area? I mean, right now for essentially cash, for money markets, for T-bills, you can get a real return for the first time in a long time. At the same time, it's not that much more return if you lock it up for longer periods of time. Does that mean you want to stay short and stay in cash? Or at what point do you try to lock up more duration because you think maybe that situation will change?
Yeah, David, it's a dilemma I saw when I first came into the business all the way back in 1981. When the yield curve was inverted, you could get 13 or 14% on your money market and only 8 on a 30-year bond. But you know what? If you bought that bond, you were going to be happy because that short-term rate is going to fluctuate and be very volatile back and forth. So this is an opportunity where I think people could feather into bonds. You don't want to extend your duration right away because it may be lower in a little while, or higher rather in a little while. But this is an opportunity to, I really think, look at bonds as a way to balance your portfolio and then still look at your aggressiveness in stocks. The stock market is so narrow right now with that magnificent 7. Most stocks are not doing well here in 2023. So You've got to have a balanced portfolio of good quality fixed income and then quality equities. And if you can find other diversification tools, then use them.
Chris, what about the situation with the federal deficit? It's something that we talked a little bit with Jay Powell about. He's not responsible for it, but I said you have to take it into account when you're figuring out the supply and demand for treasuries. And we talked to Larry Summers earlier today, and he said that's something that really is a big looming problem. It's really going to affect the economy and certainly the bond markets.
Yeah, I really enjoyed your comments with Larry this week. I thought he really hit it on the head. The federal deficit, financing the federal deficit is going to be so expensive. The average consumer really extended their credit when interest rates were low and took out 30-year mortgages and all that, which is good for them. The U.S. government didn't. It surprisingly borrowed shorter terms. So they've got a lot of debt to roll in the next 3 years. And now at 5% rates, that's going to prove expensive. It's going to increase our deficit. Could be as much as we spend on the Defense Department, we citizens will have to pay on interest on the debt. So that's going to be an enormous weight. I think Larry hit it on the head that is a huge drag on the economy, a real headwind for Washington. Not like they need more headwinds. They've already got enough trouble they create, but now it's going to be an even tougher time for them. The flip side of that, David, I'm worried about the Federal Reserve's balance. Their bank balance is enormous. Now, they basically printed money to grow that pool. Are they going to shrink it down? When are they going to shrink it down? And is that going to cause more inflation?
Final thought, Chris, give us some reassurance. Can we make money in a world with higher rates for indefinite, not just longer, but indefinite?
I think absolutely. I think zero interest rates was abnormal and an unusual thing. Even though in the last 20 years, we've seen that twice, people are used to it. That's not normal life. Normal life is for rates to be 3, and he said, up to 5. I think you can make money in that environment. The thing I would say is be careful what you wish for. We may be in that soft landing right now, and I don't hear anyone who's happy. And if Jay Powell's correct and the consumer finally slows down, they finally spent through all that savings, 2024 could be an even tougher time in the market. And again, we could test those lows. Not a severe recession, but enough of a mild one. I said before, we're going to be mucking along, and I was afraid nobody's going to be happy about that. And here we are doing okay, but nobody's that excited about it.
But you are expecting some slowdown.
I really am. I think that we're starting to see that in the consumer. The little tidbits you get about people not spending as much on dinner, cutting back on travel. I think we're starting to see, remember the consumers jumped to 26% savings. We finally are bleeding through that savings.
Yep.